Here we go. Okay, so first thing I want to say, today we are not learning anything new, okay? Today we're actually just going to spend this lecture doing a bit of a recap, going over some of the concepts and the topics that we've been talking about over the last few weeks. Now, essentially, I want you to think of today as kind of a checkpoint. See how you're going with the concepts and the topics that we've been discussing and see where you're having issues. That way you know where you need to be putting more focus and more time into studying those areas or those topics. Now, the reason I wanted to do the recap now is because, ladies and gentlemen, we only have one more topic to go. And that's next week, and that's the conclusion of the audit. So everything up until now, you need to be, use this opportunity to catch up if you need to before we delve into that final topic next week, which is the conclusion stage of the audit, all right? So there really shouldn't be anything new that you're learning today, but it's more kind of bringing everything together and hopefully you can see that process a bit more clearly. So what are we going through today? All right, well, we're going to go back over inherent risks. And we're going to do a bit of an activity to see whether you're able to identify some inherent risks. We're going to look into internal controls again and ways that we are able to identify weaknesses in controls. We'll look at the audit risk model and how we use that to determine the audit strategy or the audit approach we're going to take. Setting materiality, ladies and gentlemen, the materiality threshold. How do we come up with that number? We'll go back and revisit. The key considerations you need to have when you are designing your audit tests. Now, we actually spoke about that over the last 2 weeks. I'm just going to bring it back today just so you can see it in relation to tests of control and substantive tests, okay? And then we're going to conclude by touching on sampling and audit evidence in terms of the key considerations you need to have when it comes to those two concepts as well. So on that note, let's just get straight into it. The first one is understanding the client and identifying inherent risks. Guys, remember, the very first step of an audit is to gain an understanding of the client, gain an understanding of their business. How do they conduct their operations? What's the industry in which they are in? How are they impacted by the broader economy? Okay, gain an understanding of the business. Now, there is a specific ASA, an auditing standard that tells us we need to gain an understanding of the business. Can anyone tell me which ASA that is?
315.
Excellent. Ladies and gentlemen, write this down. It is number 315. Now, what I would also like you to write next to that, ladies and gentlemen, this is the same auditing standard that covers your assertions. Okay? It's the same standard that covers your assertions as well. Now, what ASA 315 states is that the auditor must gain an understanding of the business. And in that sense, it actually lists some of the areas you need to gain an understanding. The structure of the business, how the way it governs itself and things like that. Now, this leads me to the next question. Why do we need to understand the client? What do you think? Why do we need to actually get an understanding of how the business is working? What do you think? I'll do this in black. What do you think? Say that again? Beautiful, to know where the risks are. Ladies and gentlemen, that's the most important thing. We need to gain an understanding of the business to then do the next step, which is risk assessment. It's only once you have an understanding of the business that you are able to identify, okay, well, where are the risks in this business? Now remember, when we talk about the concept of risk in an audit sense, ladies and gentlemen, we're talking about the risk of material misstatement. Please be careful there. We don't really care about business risks. We care about inherent risks. Okay, risks of material misstatement, things that may potentially lead to the information being wrong, the information being misstated, or the information being missing, right? And what type of information do we care about? The material kind. Ladies and gentlemen, material means significant. Okay, so we need to have a good understanding of the business to be able to engage in risk assessment, to identify where are the accounts, where are the areas of the financial report where there's a higher risk of this. Now guys, this comes back to inherent risk and control risk assessment. This is all part of the same thing. Now remember, the reason why we do risk assessment in terms of the process is once you have assessed inherent risk and control risk, what do you do next? What comes right after that? What? Detection risk, and then we use that to set what? To determine what? The what? I can't hear you. Yes. Okay, guys, we plan the audit. Now, let's bring that into the terminology we want, the strategy. It is based on your risk assessment that you determine the audit strategy you're going to pursue, the approach you're going to take. Are you doing controls testing? Are you doing substandard testing? Are you doing a combination? Okay, it all comes down to that first critical step, which was gaining an understanding of the business. Now, ultimately, why do we want this understanding? Just to add one more level to it, we want to be efficient and we want to be effective. Now, what does that mean? Ladies and gentlemen, once we know the areas or the accounts where there is a higher risk of material misstatement, we focus more time, more energy, more resources into testing those areas, right? What do I mean? The area where we think that there's a higher risk of information being misstated, we do more detailed testing of that area, right? Why? Because that's effective, that's efficient. We spend more time testing risky areas and less time testing safe areas or accounts that are less risky, okay? Why do we do that? Because we want to be efficient and we want to be effective. We only have a limited amount of time with the audit. So we want to use that time to the most efficient or optimal point that we can. Now, when we gain that understanding, we figure out the assessment of inherent risk. Ladies and gentlemen, inherent risk is the risk of material misstatement that comes from the nature of the business, the way it conducts its operations, the industry in which it is in. So where is it, based on those factors, where is the risk of material misstatement, the information being wrong or the information being missing? Okay, but inherent risk purely comes from the nature. Ladies and gentlemen, one more thing to add here. Actually, let me ask you this. Do we control inherent risk within a business? Yes or no? No, we don't control it. Can we change it? No. The word is we assess. Assess means you look at it and you determine based on your understanding of what is happening in front of you, is the risk low, medium, or high? You can't change it and you can't control it. That's why you use the terminology assess, okay? Now, let's test your understanding of inherent risks and your ability to identify inherent risks. Ladies and gentlemen, here's your question. And we're going to do a vote, so I'm just going to ask you to raise your hand to which one you think it is. The question is, which of the following events will most likely lead to a higher inherent risk for the organisation of Apple? So you've got 4 options, and I want you to think about this. Which of these 4 will result in a higher inherent risk? The highest inherent risk, because some of them might be that. But which one is the one that results in the highest? So think about it. Is it if Apple acquires Beats for $2.2 billion in goodwill? Is it B, if the sales of the iPhone 6 are lower than expected? Is it C, if the iPhone 7 batteries are exploding and harming consumers that have purchased them? Or is it D, if Apple is in discussions regarding the purchase of Tesla? So which of these do you think will result in the highest inherent risk implications? So let's do this. Now, whichever one you think it is, just raise your hand to it when I ask. Please vote. This is not accessible, right? This is just seeing how learning is happening in the classroom. So here we go. Please raise your hand if you think that the one that results in the highest inherent risk is the first one. Apple acquiring Beats for $2.2 billion in goodwill. Raise your hand. Are you sure? Okay, one person. All right. 1.5? Yeah, okay, 2. Second one, sales of the iPhone 6s are lower than expected. Okay, a few more. Oh, okay, interesting. C, the iPhone 7 batteries are exploding and harming consumers. Okay, I think that looks the same with B, all right. And D, Apple is in discussions about purchasing Tesla. Interesting. All right, ladies and gentlemen, let's get to the answer first. It is indeed C. Okay, let's go through this. Let me tell you why this is the case first of all. Ladies and gentlemen, this event here, option C, has the one that has the greatest risk. Now let's break down this event into 2 main sections. The first one, the batteries of the phone, the batteries of the phone are exploding. Okay, now let me ask you a question. If the batteries of this mobile phone are exploding, are people going to buy it, yes or no? No. Now, can Apple sell it, yes or no? Ladies and gentlemen, when a company cannot sell its inventory, that is called product obsolescence. Write that down, product obsolescence. The product is what we call obsolete. Now, what does that mean? Ladies and gentlemen, that means the business can't sell the product. They can't sell their goods. Now, what's the implication? Here we go. Ladies and gentlemen, if a business cannot sell its product, it cannot include it as inventory. Inventory is only the goods that the business can actually sell. So as soon as it gets to the point that the business cannot sell the goods are termed to be obsolete, which means inventory has to be written down. Those elements, those items or those inventory products, they need to be removed from the inventory account. Think of it this way. Expired goods, expired food products, they can't sell that anymore. They need to write it off. That's the terminology. You write it off, which means you remove it from your inventory account. So first of all, when we see this as an auditor, we'd want to be looking into the inventory account. We want to make sure that these now obsolete products are removed from the inventory account. Here's the second part of the issue. They're harming consumers. Ladies and gentlemen, the fact that it says harming consumers means the consumers already had the product. Now, what does that lead to? 2 key things. The first one, warranty. Was there a warranty on this product? If there was a warranty with the product, then you need to also look into warranty expense and warranty payable. Okay, because they're going to now make claims. So you need to look into those areas. One more. Take it one step further. Lawsuit. If they are actually harming consumers, they might turn around and they might just sue. Now, if that happens, again, here are the implications. They will have legal expenses on the company, so you look into legal expense account. You know what you also look into? Potential contingent liability. Remember what a contingent liability is. The way I always describe it, it's a maybe liability. If they go to court, if this case goes to court, depending on what the judgment is, the business might need to pay damages. Now, if that's the case, that's a contingent liability until that judgment is made by the courts. So they need to disclose that in their financial report. Okay? So from one event, a lot of things come from it. So please be mindful of that. Out of the 4, that's the one that led to the biggest issues when it came to inherent risk. Now, just coming back to goodwill, I'm surprised only 2 of you put your hand up here. Ladies and gentlemen, goodwill is probably the second highest risk here. The reason is this, goodwill, judgment is involved. Judgment is involved in that process of calculating goodwill, so please be mindful of that. Now, bringing it one level down, so the next one would be B, which most of you, or it was on par, B and C were on par. But the reason why this one is the next level down, remember what this issue is. The sales were lower than expected. Ladies and gentlemen, that's not an inherent risk, that's a business risk. It's a risk that the business will not meet their targets. Now that's an issue for them. because it means that they might not make or achieve the objectives that they had set for themselves. But that, remember, inherent risk is the risk of material misstatement, the numbers being wrong. If the sales are lower than expected, that's not the number being wrong. That's an issue in terms of the business not meeting, I guess, the objectives that they had. I feel like a lot of you actually misinterpreted this. And just let me know if this is correct. Did you think that the sales were lower than expected, therefore they might manipulate to make it higher? Is that what you thought? Okay. Think about it this way. If it says that the sales are lower, that means they were recorded as lower than they thought that they would be. Okay? So just be mindful. Go with the facts given to you in that sentence. All right? So in this case, it's a business risk. Now, here's the only thing I want to add. The only time that B, that option, will lead to an audit issue is if it's so bad, the sales are so bad that it impacts on the business's ability to keep on operating. And that, ladies and gentlemen, is called a going concern issue. Write that down, going concern issue. And we're going to be talking about that next week. Okay? So that's the only time where B would actually be an issue, if it's so bad that the business might not be able to continue. And that's going concern issue, which, as I said, we'll discuss next week. D, and I'm surprised people put their hands up for this one. D, guys, nothing's happened. They're just talking. They're just discussing whether they should potentially go ahead and purchase Tesla. Right? So nothing's actually happened here. So please be mindful, if it's just at the discussion stage, it's not really going to have any implications until something solid takes place. Does that make sense to everyone? Head move it for me? Yeah? Okay, great. Now, how do we measure free from material misstatement and true and fair? Ladies and gentlemen, one word, assertions. We use assertions as the foundation of audit. They are what we call the characteristics of truth. They are the elements that we use to determine whether the financial report is indeed true and fair. Okay? Critical. Absolutely critical to us doing the audit. So, ladies and gentlemen, it is incredibly important for you to know these assertions, be able to identify where the which assertions are at risk, and link your procedure to the assertion you're trying to test. All right? Now remember, you've got 5 assertions relating to transactions, and you have 4 of them relating to balances. The reason why you see this table, and by the way, you've seen this before, when we went through this in week 4, I believe, we've put it in this order because they're related. Occurrence and existence are related because both of them are fundamentally answering the same question. The question being, is it real? Occurrence is it real? Did the transaction really occur? Existence, is the asset real? Does it really exist? So they're both related in the way that they're answering the question of, is it real, right? Accuracy and valuation allocation, both of them are related to the dollar amount and the quantity, okay? They're both related in that way. Completeness and completeness, one question, is it missing? Is anything missing? Is the account or is the transaction complete? Okay? Has anything been omitted, whether intentionally or unintentionally? That's the completeness assertion. Cut off. Has it been recorded in the correct accounting period? That's a time frame one. Okay? Rights and obligations. Did the business have the right to record the assets, or did it have the obligation to record the liability? Now, often this one does come back to contracts and things like that, okay? Classification, is it recorded in the right account? Okay, so you really need to know these assertions. Everything revolves around the assertions. And by the way, I mentioned this earlier before the lecture started. What you'll notice is one thing. Every single week, since I think week 3, every single week, your quiz questions have had one common theme, assertions. Because everything revolves around assertions. It is the foundation of audit. Everything you do is you collecting evidence to support every single assertion, okay? For every single account, by the way. So please be mindful, very important. Now, let's do a bit of an exercise to see how you're tracking with this. So for each of these audit objectives, what is the transaction assertion that it is related to? Here we go. The correct quantities are recorded on the sales journal entry. What assertion is that? Excellent, good, accuracy, fantastic. Sales journal entries includes only transactions made to real customers. What's that? Good, occurrence, fantastic. Cash payment transactions are recorded on the correct dates. What's that one? Beautiful, cut off. All inventory sold to customers are recorded as cost of goods sold. What the keyword being all? Completeness, good. Just not to get confused with that. Final one, sales revenue are recorded for transactions involving the sale of inventory rather than the performance of any service. What would that be? Guys, the reason I wanted to include this one is if it was the performance of services, which account should it be recorded in? Yes, service revenue. Remember, you can only record sales revenue if you sell a physical asset, physical inventory. If you are performing a service of any kind, then that should be service revenue. That's a classification issue, okay? Remember, classification is the one that relates to the correct account. Good job. Okay, now we move on to the second topic, which is internal control. Yes? I can't go back, yes. Continue, yep.
Just with the first one, correct quantities are recorded. Could that also be argued as
Completeness is more so if it's missing. So if it's the correct quantity that's been recorded, that's going to translate to the number being wrong. That's why it links back to accuracy. Correct. Yes, correct. Because think about it, if the quantity was 10 and you recorded as 15 or you recorded as 5, the number's going to be wrong, but then the completeness only happens on the one side, right? So it's more accuracy. Great question. Great question. Yep. 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 Yeah, you could say that. Yeah, you could say that as well. The keyword just being all, I wanted that to be the focus, but yes, that could have been the case as well. Good job. Okay, with controls, the first thing I want to say about controls is this. If you go back to, I believe it was 3 weeks ago now, when we discussed controls, there were 5 categories, or sorry, 5 components of an internal control structure. So there was the control environment, there was the information systems, so on and so forth. Ladies and gentlemen, our focus is on the third component, which is control activities, okay? That's where I want you to be focusing. Now, there are 5 types or 5 categories of controls, as you can see on the screen. I need you to make sure that you understand every single one of these and are able to come up with examples of each one as well. Now, we went through this in quite a lot of detail a few weeks ago, so please do go back to your notes if you need to, but please just remember the following. I'll touch on these quickly. Adequate separation of duties, making sure that the responsibilities at different points of a process go to different people. Remember, the objective behind segregation or separation of duties as a control, the idea or the objective is no one single employee should be in a position to perpetrate a fraud and cover it up. So we often have people involved at different stages who have different responsibilities to separate the process, okay? So if someone does something wrong, it's going to be picked up later on by the other people in the process. You don't want anyone in a position to perpetrate a fraud and be able to cover it up. That's why often people that have access to the inventory are different to the people who do the journals, okay? So just be mindful of that. Proper authorization of transactions and activities, making sure that people are approving transactions according to their authority limits. Okay, we've discussed this one before. Making sure that there is adequate documentation and records. Guys, by having documentation and having records, it provides what we call an audit trail, a paper trail. It means that we can go back and check it. Okay, without that, it's an issue. If they're taking orders over the phone, how do we check that the order was right? How do we check that the order even happened? Right? You need documentation to support the process and enable a review or a check of what has taken place. Physical controls over assets and records. Guys, passwords, security passes, security guards, locks on the door. These are all physical controls that are trying to keep away unauthorized people, okay? Independent checks on performance. They're the checks to ensure people are doing the right thing. So please make sure that you are comfortable with these 5 categories and are able to provide examples if required. Now, how do we find control weaknesses? We can either talk to the client, we can talk to management. Now, here's the thing, inquiries is talking, asking questions. That on its own is absolutely insufficient. We need to do much more than that. That could be the starting point. Say, hey, how does this process work? Or what do you have in place? They can answer the question, but you need to get more information. You need to gather more evidence. You need to read their policies and procedures, inspect documents and records as part of the process. You can observe people carrying out certain parts of the process. But the key thing that we do, ladies and gentlemen, we conduct walkthroughs. We've discussed this as well. A walkthrough is when we actually sit down with the client and we walk through the process, step by step, documenting it as we go along. It's only by doing this that we can identify potential types of misstatements that could occur. It's also here that we're identifying where they don't have controls, or the controls don't look good. They don't look like they're doing what they're supposed to do. Here's another thing. It's also during this process or during this particular activity that we identify what controls they do have in place. And that leads us into being able to make a control risk assessment and from there do our controls testing. Okay? So walkthrough is probably one of the best ways that we gain an understanding of what the process is supposed to entail, the controls they have in place, the controls they don't have in place. Now remember one thing, guys, an absence of a control. So if they don't have a control where they should, that in itself is a weakness, okay? When they should have a check and they don't, that's a weakness. And we only know that's the case by walking through the process, all right? Now, let's see if you can get these ones. Here we go. So I've just provided a couple of pictures for you, and I want you to look at this picture and identify where is what is the internal control here? Where's the control? Sorry? Yes. These ones here, ladies and gentlemen, they are the alarm gates. The alarm gates, when you walk through the alarm gates with something that hasn't been scanned, they go off, okay? Now, here's the question I have for you. You could call them security gates, whatever you like. Here's the question, what's the risk that that particular control is trying to deal with? Yeah, theft. Theft. Alarm gates. Now, ladies and gentlemen, this brings me back to something I told you all when we started talking about controls. Every control is there to deal with a risk. Controls are there to either reduce a risk or to prevent a risk from happening in the first place. Why do we have this? To deal with the risk of theft, to stop people from stealing. Or if they do steal, the alarms go off and someone can come and check their bags and get whatever it was, okay? So every control is there to deal with a risk. Remember, control activities is any task, any check, any activity that the business has in place to deal with a risk, to make sure that the process is happening correctly, right? To reduce an issue or to reduce a risk or prevent a risk, okay? Please make sure you're well aware of that. Now let's do this one more time. Here. Where do you see the control in this particular picture? Yes. Right there. Okay? Guys, there's two things there. There's a security tag and there's also the barcode tag. Right? There's actually two here. Now, let me write this one down. So you've got the security tag and you've got the barcode. Now, these two things, they're actually dealing with two different risks. The security tag, like last time, theft, because that's the tag that will actually set off the alarms on the barriers that you walk through, that you saw in the previous image. The barcode, however, and this is what I mean, everything is there for a reason. The barcode, this thing here, it's there to deal with two things. Number one, think about retailers like this would have probably been in a store like Kmart or Big W or something, or Target or something. And essentially there's two key issues there. Number one, there's a lot of inventory. There's a lot of different types of products that they sell. And each one has a different price. So how do they make sure that the right product and the right price is being recorded? Having a barcode that needs to be scanned. Because by scanning it, they are certain that the right information is going to be recorded, right? So the right price, listen to this, the right price is going to be recorded. Ladies and gentlemen, that's accuracy, right? By requiring that barcodes need to be scanned in order to be sold, that's occurrence. Because by scanning it, the sale really happened. Do you see what I mean? So everything that you see in everyday situations such as this one, they're giving you examples of controls. Controls are there to deal with the risk. The risk of accuracy is the risk here is that it's the wrong product that's going to be recorded or the wrong price that's going to be recorded. We're trying to deal with that. Occurrence. Making sure the sale actually happened because you've got a record of the product being scanned at the register. Okay, things like that. Now the security tag, that relates to theft. If someone steals it, then the alarms go off. Same way as the last image that you saw. Okay, so just some everyday examples for you. Now, we'll just do maybe one or two of these ones. So the situation I want you to think about is the self-serve checkouts that you see at certain stores nowadays, including, Coles, and we've got Woolworths up the road. So considering the self-serve checkouts, what are some risks that relate to having self-serve checkouts? What do you think? What's a risk? Yep. Yep, okay, so picking the wrong product, yep. So wrong product being recorded. Now, here's my question to you. The wrong product being recorded, what is a control that Woolworths has over that? What do you think? Sorry? Okay, there's a couple actually. First of all, what did we just talk about? Barcodes. So any product or majority of products would have barcodes. So that deals with the risk of there being the wrong product being recorded because you need to scan the barcode. Now, where is this a bigger issue? Fruits and vegetables that don't have barcodes. Now, remember the example I gave, the story I told you about the grapes and the cherries? Yeah? With fruits and vegetables, you actually have to pick what fruit and what vegetable you are buying. You need to pick which type of apple you are purchasing, right? So the risk is, well, you pick the one that's cheapest, okay? Now, here's the thing. There's two things there. Number one, there's someone monitoring, okay? There is one person often that stands there and watches everybody scan their products and pick their fruit and vegetables. Now, here's the problem. Do you think that this is a particularly strong control? No, because if you go and you look, you'll notice there's usually one, maximum two people involved in this activity. And there's more than two registers, okay? So it's a way that they're trying to deal with the particular risk, but it's often not the most effective thing. But here's the thing, if you go back to your notes when we first started talking about controls, businesses want their controls to be what we call cost effective. What does that mean? That means that they are only willing to pay to implement a control as long as the benefit of it is higher than the cost of implementing it. Now, given this particular one, what this essentially shows us is that they don't think that this risk, right, they don't think this outweighs the cost of having a more effective control put in place. So they think that for now, this is sufficient. I think that's going to change soon, but at the moment, that's the only control that they have for it. Now, you mentioned the weights, okay. The weights, let me see. I was going to draw, but I won't. With that one, so if you notice, whenever you scan a product, you have to put it in the bag. It's not until you put it in the bag that the system allows you to continue, okay? Now, that's a control. It's highly annoying for a customer, but the control there is trying to check that you are scanning everything that you are buying. Because if you put something in your bag that you haven't scanned, and they measure the weight, and the weight doesn't correspond to what the system thinks it should be, they think that there's more or they think that there's less, there's a system basically sends out a warning and says you need an assistant to come and help you, okay? That's a control. The control is that you're either taking more than what you have scanned in, or you're taking less, which is kind of weird. All right? So that's another control that the businesses have. Now I'm just going to say one more issue potentially, duplication. Scanning the same thing twice. Now let me ask you a question. When people do the self-serve checkouts, who are the people looking at the screen? Who's the person looking at the screen? You. So if something is scanned twice, are you going to do something about it? Yes. So this is often not really that big of an issue. Why? Because the person that is actually scanning their own products would be mindful of that. And if that happened, they would say, hey, come and delete the second item that's come up, right? There's nothing for them to gain by this. There is something for them to gain here. And that's why they probably need more effective controls to be put in place, okay? But guys, the key reason for the last 3 slides is to show you that controls are commonplace. You have them all around you. It's not an audit-specific thing. Controls are there to deal with risks, okay? Now, once we have our inherent risk assessment and our control risk assessment, we go back to our audit risk model. Now, the form of the audit risk model, please write this down, is audit risk is a function of inherent risk times control risk times detection risk. Ladies and gentlemen, audit risk, number 1, is the risk that we provide an incorrect audit opinion. Okay? Now, before I go anywhere, would we want that risk to be high, medium, or low? I need more than 2 people responding. Ladies and gentlemen, audit risk is the risk that the auditor will provide an incorrect audit opinion. Do we want that risk to be high, medium, or low? Low, absolutely. Okay? Absolutely, you want it to be low. So remember, we assess these 2 elements and we set this element. We determine what level we want our detection risk to be. So what sometimes we see is you can figure out what this element is by rearranging this formula. Because if you rearrange it, you can find that detection risk is equal to audit risk divided by inherent risk times control risk. So you could think about it in that way as like a calculation, or probably more effective way, go to your next slide, use this table. Okay? This table tells you, depending on what level of risk you assess inherent risk to be and what level you assess control risk to be, what is the detection risk that you are willing to accept or what you are willing to set as part of the audit. Okay? Remember, the lower the risks, inherent risk and control risk, the higher your detection risk. Guys, inverse relationship. Okay, there is an inverse relationship between those elements. So if the lower the inherent risk and control risk, the higher the detection risk. The higher the inherent and control risk, the lower the detection risk. Now, why do we need this? Because it is based on this that we determine our audit strategy. When we assess detection risk when we set detection risk as being low, actually, you know what? Let me go back a bit. Guys, detection risk would only be set to be low if inherent risk and control risk were high. What does that mean? If the risk of material misstatement is high, then you want detection risk to be low. Remember what detection risk is. Detection risk is the risk that your procedures will not detect the issue. If the risk of issue is high, you want the risk of you not picking it up to be low. How do you make it low? You do more detailed testing. Ladies and gentlemen, look, if you want it to be low, you do more detailed testing. What does that mean? You're taking a substantive-based approach, which means more detailed testing. Alternatively, if you think that inherent risk and control risk is low, it's a pretty safe environment, you don't think that there are many issues, you're willing to take a higher detection risk, a higher risk that you miss something. Why? Because you think it's pretty safe. You don't think that there's a very good risk of issues happening in the first place. You think inherent risk and control risk are low. So what do? You focus on testing the controls. Okay? Now, if there's any differences in terms of the low, the medium, and the high, you'll often get to a medium point, and that means you would do a combined or a mixed approach. You do some controls testing, some substantive testing. The only extra thing I want to say here is this. Let me ask you this, guys. If you assess control risk to be low, are you going to do controls testing, yes or no? If you assess control risk to be low,
Yes.
I need more than 3 people. So we're going to ask this, and this doesn't matter. I need you to use your voices, okay? So guys, if you assess control risk to be low, actually, you know what? Let me change the question. If we assess control risk to be low, does that mean we think the controls look good or they look bad? So are we going to test them, yes or no? Okay. Same question, but medium. If we think the control risk is medium, if we assess control risk to be medium, are we going to test the controls? If we assess control risk to be high, are we going to test the controls? Very good. Okay, remember that. Remember that. So what I'm trying to remind you is this. If you're taking a substantive-based strategy and you had assessed control risk to be high, you're not doing any controls testing. Okay? Remember, you only go ahead and do controls testing when the control risk is assessed as low, which means you think it's good, or medium, which means you think it's okay. If you assess control risk to be high, you are not going to go ahead and test them because you don't think they look good. So why would you waste your time? So please be very mindful of that. Now, next one is setting materiality. So with materiality, what is the standard that covers materiality? Do you remember this?
320.
Wow, well done. 320. Okay, what is materiality? I'm just going to change this and add one word, the threshold. What is the materiality threshold? Ladies and gentlemen, it's your reference point, okay? The threshold is the maximum level of misstatement or the maximum amount of misstatement you are willing to accept, you are willing to tolerate before it starts to impact on your audit opinion. That's the link to the final stage of the audit. So whenever you find your misstatement, you compare it to materiality. If it's above materiality, it's a problem, because that means by definition, it's a material misstatement. If it's below materiality, it's not a problem because it's not material, right? Remember, the only material misstatements will impact on our audit opinion. So the threshold is the maximum amount of misstatement we are willing to accept. Now, how is it calculated? Remember, you pick a base. Okay, you use your judgment and you pick a base. Now, you often want that base to be something that reflects the performance of the company. You want it to reflect a driver of the performance of the company. So often, we like to use things like net profit before tax or total revenue, right? Because that reflects how the business is performing. But here's the thing. Not only do you want it to be relevant, you also want it to be stable, something that you can kind of rely on. So if you have an organization whose profit or revenue is fluctuating, you're not going to use those as your base. What you're going to use instead in those cases is total assets or total equity, because they often stay quite similar over time. So that's your base. Now, once you have your base, you multiply it to a particular percentage. Now, again, judgment, because you use judgment to determine what percentage to use. Now, there are some guidances out there in terms of what percentage to use, one of them being the accounting standard that deals with materiality, which is AASB 1031. Okay, and if you go back to your notes, we had a slide on this, and that gives you some guidance, but a lot of this comes down to judgment. Now, for the purposes of your exam, you don't have this level of judgment yet. So I'm not going to be testing you on your ability to calculate materiality, but I will definitely be testing you on your ability to identify whether something is material. Material means significant. Significant enough to change someone's decision. That's the definition of materiality. And we're going to be delving more into that next week as well. So when would the auditor adjust or change materiality threshold? Guys, remember what the calculation was. When would you adjust it? Well, if you decide that this is not correct or this is not correct, right? If the foundation of your calculation changes, then your answer is going to change. Your threshold is going to change. Now think about it this way. If you thought, or if you based your materiality using the base of total revenue, and total revenue was $1 million, and you calculated your materiality number, but then later you found out that it's actually not $1 million, it was overstated and it's actually 500,000, then your base is different. So your calculation is different. So the number is now different, okay? So one way that you might adjust materiality is if one of the components or both of the components you use changes, okay? Here's another one, risk. If you start doing your testing and you realize that the risk of material misstatement is actually higher than you thought, guys, write this down, there's an inverse relationship. What does that mean? The higher the risk, the lower the materiality you set, okay? If there's a higher risk of issues, you will set the maximum amount you're willing to tolerate as being wrong, you would set that to be lower because it's a more high risk situation. So just be mindful of that as well. There's an inverse relationship there. Now you've seen this slide before. I've actually shown you this slide 2 weeks in a row. And the key considerations you need to have when you are designing your audit tests, ladies and gentlemen, are these. Use the correct terminology. Inspect, observe, trace, vouch. Use the correct terminology. Be specific. What do I mean? Be detailed. When you are designing a test, be really detailed as to what that test involves, okay? If you are tracing, what are you tracing? What documents are you tracing? What specifically are you looking at in each of those documents? Which direction are you going? Ladies and gentlemen, let me test this out for you. Tracing. When you do a tracing procedure, are you going forward or are you going backwards? Good. Make sure your test corresponds to that. Tracing is going forwards. Vouching is going backwards. Please be careful. You know what, on that note, what's the end point of the process? What's the last thing that happens in a process? Journal. If you're doing vouching, you're starting at the end, which means you're starting at the journals. Okay, so just be careful about the direction, because often what I also see is they use the correct terminology, but it's actually not matching what they're doing, okay? So please be careful of things like that. And by the way, the best way to get more prepared is just by practicing, okay? Practice. Make sure your procedure matches the assertion. We talked about this quite a lot last week. That's critical. Because again, if you're giving me the right terminology and you're giving me the right procedure, but it's actually not matching what it is you were supposed to be testing, it's not gonna help. Okay, it's not going to help. If you were testing for existence and then you told me that you would recalculate the sales invoice, well, recalculating the sales invoice is a really good procedure, but not for existence. Okay, so make sure that that match is happening. Now, when we talk about tests of controls, here's the question for you. Do we test every single control? Yes or no? No. Ladies and gentlemen, the key word is you want to be efficient. You want to be efficient. And I think I've shown you this before, but the best way to think about this is be visual. If we've got risk 1 and risk 2, you know what? And risk 3, and we have control 1, control 2, control 3, and control 1 is linked to risk 1, control 2 is linked to all 3 risks, and control 3 is linked to that third one. Ladies and gentlemen, which of those controls do you want to test at least first? Absolutely. Why? You want to be efficient. You will have, in businesses, you will find this. There might be situations where there's one control testing a bunch of assertions or a bunch of risks, as the case here. You might also have a bunch of controls for one risk. You want to be efficient. You want to test the control that's actually going to tick off a bunch of assertions. Because, ladies and gentlemen, you need to test and gain evidence for every single assertion, right? You need to test every single assertion. You need to gain comfort over every single assertion. But you want to be efficient in doing so. So let's test this one out. For each of these control activities regarding inventory, which assertion is being verified? Here we go. Twice a year, Coles conducts a stock take of its inventory. What assertion is that giving you comfort over? Ladies and gentlemen, what is it? Existence. Good. People in the back, I need you to get involved. Angus, get involved, all right? Next one, all stock or all inventory must be recorded in the inventory system immediately following the completion of the receiving report. So once they come in, we need to immediately record all of it. What assertion is that linking to? Completeness. Guys, key word. Okay, key word. The prices for all inventory purchased by the company is set in fixed 12-month contracts and cannot be adjusted without approval. What assertion is that? Good. And the final one, and I kind of mentioned this earlier, but contracts state that the company takes ownership of the inventory once it arrives in the warehouse. What assertion is that? Very good. Okay, use this. Because here's the thing, once you know what the control is supposed to be doing, it's pretty straightforward to figure out a test for it, to check that it's actually happening. All right, designing substandard tests. There's only a couple of things I want to say here. Number one, and I mentioned this earlier, you need to get evidence for every single assertion, for every single account. Now, in doing that, you want to be efficient in that endeavor. Okay, so you want to try to come up with tests that test multiple assertions at the same time. Ladies and gentlemen, for example, if you're doing a procedure like tracing, you're starting at the beginning and you're tracing it through to the end. By doing tracing and making sure that it's been recorded at the end, that's completeness. But if you check the numbers along the way, that's accuracy, right? If you check that it's being posted on the correct date, that's cutoff. If you're checking that it was posted to the correct account, that's classification. You got 4 assertions in one test. You want to be efficient, okay? Now, in saying that, I've said this so many times, there is more than one procedure to test an assertion. Don't limit yourself. You can be creative. As long as it is linking, you're going to get the marks. So I don't want anyone to think that there's only one solid, absolute answer. Often there isn't. Okay, so as long as it's making sense and it links, you're going to be okay. Now, coming back to this, there will be some assertions that are at greater risk than others. And for those, we often perhaps might want to get more comfort. So what we'll do more testing. We'll conduct more procedures for those high risk areas or those high risk assertions. Why? We want to make sure that we have more evidence, corroborating evidence, that is consistently supporting the same conclusion. Because if you have more evidence that's telling you the same conclusion or leading to the same conclusion, you're more confident in that conclusion. And the higher the risk, the more confident you want to be in the conclusion regarding that area, okay? So again, all of this is quite logical, right? So I'm just trying to emphasize parts of it, but it is quite logical. When you are designing tests or conducting the process, you saw this slide last week. Guys, start with the risk. What is the risk? Once you know what the risk is, that leads you into the accounts affected. That leads you into the assertions impacted. Now we're going to do a quick exercise on this next. Once you have the accounts, the risk, the accounts and the assertions, you can design a procedure. The key thing you need to be mindful of is making sure that the procedure matches the assertion, okay? Now remember, there's a link between 3 to 4. 4 is, well, what's your population? Your population is the starting point of your procedure. So whatever your procedure, whatever the test was, wherever you're starting that test, that's your population. If I'm doing a tracing procedure and I start with sales orders, that's my population. And I pick a sample of sales orders and I carry out the test, okay? So your starting point is your population. Once you know your population, you pick your sample. Now, I'm going to mention this later, but I'll do it now. Guys, in this subject, I am not going to test you, or I'm not going to ask you to calculate a sample size. It's not going to happen. I know it's in your textbook, but I'm not going to ask you to calculate a sample size. And I've mentioned this to you, why? Because every audit firm does it differently. So the only things I can really ask you regarding sampling is, number 1, pick the appropriate sampling method, given the test. And number 2, given this factor, would you increase or decrease your sample size? That's it. So you need to know about the different methods and which one is appropriate given the test. And also, given certain situations, would you pick a bigger sample or a smaller? But I won't ask you to actually give me a number because every audit firm does it differently. So once you have your sample, you conduct your test and you evaluate your results. Okay, so it's pretty straightforward and we went through this last week. Now, let's do a exercise. And I'm going to ask you to help me out here. And again, you can use something like this to assist you if you like. But what I've done, and we're only going to do a couple of them. With this, if you are told that the risk is that the business wants to improve its company performance, so wants to look better to potential investors, for example, with respect to each of these accounts that I've listed, what's the risk? Now, here are your options. Is the risk overstatement or understatement? Okay, so let's go through them. When it comes to sales revenue, if the business wants to look better, is the risk overstatement or understatement? Over. Let's write that down. Good. Now, link it to your assertions. Guys, if the risk is overstatement, what are the assertions at risk? Sorry? Accuracy. Good. How would it be accuracy? What do you think? How would it be accuracy? How did you get to accuracy? Yes, absolutely. He said just state a higher number. You know why I'm doing this, guys? Because the link to your assertions comes down to one fundamental question. How can they do it? How can they overstate sales revenue? There are 3 ways that a company can overstate sales revenue. Number 1, record the sale at a higher number. The sale happened for $1,000, but they record it as $10,000. Ladies and gentlemen, that's an accuracy issue. Number 2, how do they overstate sales? By including fake sales, including sales that didn't actually happen. What's the assertion there? Occurrence. Third way, they include a sale that actually happened, but the sale happened in July and they included it in June. What's that? See what I mean? So the way that you get to here, cut off. The way that you get to the assertions column is by asking yourself, how can they do it? How can they achieve this overstatement, right? Let's do this again. This time we're doing it for loans payable. Now loans payable, actually let me ask this question. Loans payable is what type of account? Thank God, okay, liability, good. That's step 1. All right, now loans payable is a liability account. Would the risk be overstatement or understatement of liabilities? Good, write that down, under. Now how could they do it? Any ideas? Michael, what was that? Wrong number, yeah. Wrong number, okay. So instead of recording the loan for $1 million, they record it as 100,000. What assertion is that? Good. Valuation and allocation. Remember, it's not accuracy because this is balance sheet, okay. What's another way that they can understate loans? Not including it. What assertion is that? See what I mean, guys? Ask the question, how could they do it? Okay, good, you're doing really well. Let's do one more, let's do COGS. Cost of goods sold, would they overstate or understate if they want to look better? Under. How can they do it? How can they do it? Any ideas? First of all, where does it go? Which financial statement does it go with? Income statement. What type of account is it? Yeah, guys, it's an expense account. It doesn't sit with the rest of the expenses. It sits on the top, but still it's an expense account, okay? So how can they understate this account? Sorry? Someone just said something, and it was right, but I don't know who it was. Be confident. You got this, and you've just done this twice already. What do you think? Wendy, what do you think? You can do it. Come on, it's an expense. How could you understate an expense? Go off the, sorry? Yeah, so how would you understate when it comes to accuracy? Yeah, a bigger number or a smaller number? There we go, okay? Put all those elements together. Guys, you can understate by including it at a wrong number, a lower number than what you should. So the cost of goods sold should have been recorded at $1,000, but they recorded it as 100, for example. So accuracy. Anything else? Cut off, yes. So remember, every time that you record a sale, there are two journals. Debit accounts receivable, credit sales revenue. That's what we call the money flow, or cash if it's a cash sale. And the second one is the goods flow, which is debit, COGS, credit inventory. Okay? Now, what could potentially happen, and this has happened in the past, is that the first journal, the one involving sales, was recorded. The second journal, the one involving COGS and inventory, wasn't until next year. Okay? Now, here's the thing. Number one, if it wasn't recorded at all, that's completeness. If it was recorded, but it was recorded in the wrong period, that's cut off. Do you see what I mean? You need to sit down and you need to be asking yourselves these questions. And be confident you got this. You just got to bring it together. Okay? Bring it together. Now, I'm just going to quickly do this one because it's important, which is bad debt expense. Now, first of all, the risk and the assertions are exactly the same as COGS because it is also an expense account. All right? But here's the difference. Bad debt expense is even more risky. Why? One word, estimates. If you go back to your accounting A information, bad debt expense, the whole process whereby we do accounting for bad debt, you actually have to estimate quite a lot. And by estimating, what are you doing? You're using judgment, okay? So right off the bat, there's a higher risk, particularly with the dollar amount, because that's what you're estimating, essentially. So there's a risk with accuracy, in particular, more so than anything else. Now, here's the other part, though. Ladies, let's see if you remember this. When we record bad debt expense, it's an expense, so we debit bad debt expense. What do we credit? What's the other side? The allowance. Ladies and gentlemen, this is the other thing that you need to be very mindful of. It is extremely rare for any account to live in isolation. Because what do we have? We have double entry bookkeeping. Every single account has a brother-sister account. Now here's the link. Guys, if there's an issue with one account, there's an issue with the other. Right? You need to make those links as well. So if you're saying that there's a risk of accuracy with bad debt expense, you know what you're also saying? There's a risk with valuation and allocation with the allowance account, because that's the other side. If there's an issue with one side of a journal, there's an issue with the other side of the journal. Does that make sense? Head movement? People in the back? Yeah? Okay. So just remember, you have to find the brother-sister accounts. Just go back to your journals. That's my biggest advice to you. Okay? I've been saying this the whole time. Don't underestimate your accounting knowledge. Okay? So again, the way I encourage you to practice this is using templates such as these ones. In particular, when you're getting to this one, go back to your journals. Okay? Find the related accounts. It is often very rare for it to just be the one account. Guys, let's do a practice run. If we're looking at depreciation expense, what's the other side? Accumulated depreciation, good. If we're looking at salary payable, what's the other side? Salary expense. If we're looking at COGS, what's the other side? Yes, do you see what I mean? Okay, go back, because none of those are going to exist in isolation. If something is an issue with one account, it's going to be an issue with the brother-sister account. How do you know what the account is? Go back to your journal. Okay? Go back to your journal. Look back at your debits and credits. I know you thought it was over, but no. Okay? Now, this slide I've actually put because there's one key thing I want to tell you. Now, if you look at the slide, this isn't new. You saw this last week, but I just combined the two this week for you because there's two key things I want to remind you. The key terms, ladies and gentlemen, when you're doing internal controls testing and the control doesn't work, it is called a deviation. That term is specific to that test, right? If you're doing a controls test and the control does not work, it fails, that's a deviation, okay? If you're doing a substantive test and you find an error or the number being wrong or the number being missing or whatever the case may be, that's called misstatement. Now, why am I highlighting this? Because you need to be very careful here. If you're doing a controls test, something goes wrong, that's a deviation. When you're doing a substantive test and something goes wrong, that's a misstatement. Misstatement links to a dollar amount. Controls are not testing, I repeat, controls are not testing a dollar amount. Controls, you are testing whether the process is happening correctly. Did the manager sign this document? Now, whether that document was a sales order for $100 doesn't matter, because you're not focusing on the dollar amount, you're focusing on that signature when you're doing a controls test. So if you find that that signature is not there, that is a deviation, right? Now, it doesn't matter what the dollar amount of that document was. You're focusing on just the signature, and I'm telling you this for a reason. Okay? Telling you this for a reason. So you got to be mindful in terms of the terminology. When you're doing a controls test and the control doesn't work, it's a deviation because you're not looking at the dollar amount. When you're doing a substantive test, you are looking at the dollar amount. So if it's wrong, it's called a misstatement. The rest of the process is pretty consistent because in both cases you identify or you determine what your tolerable rate of deviation is, what rate you're willing to accept, and your tolerable level of misstatement, which by the way is materiality, right? You then go ahead, you conduct your tests, and then you calculate the actual rate of deviation and you project your misstatement amount. Now, once you do that, then you evaluate your results. By the way, we went through this in quite a lot of detail last week, so I'm not going to go back through it, but there's one key thing I want to say. You want to always investigate the source of the issue, right? And if you want, you can then collect another sample and test it. Question: if you decide that you want to test another sample, do you disregard your first sample, yes or no? No. What do? Combine the results. Excellent. Do not disregard anything because the results were actually valid. The only thing I want to mention here is, remember, at the end, to get your final conclusion, you compare the actual versus what your tolerable was, okay? And depending on that result, you get to your conclusion. There's one thing I just want to say. Materiality. Materiality as a concept is only relevant if you're doing a substantive test. That's it. Materiality is absolutely irrelevant when you're testing controls. Why? You're not testing a dollar amount. You're testing a process. So for example, coming back to up here, right? If this signature was not there, you can't say, oh, it's okay, it's only worth $100. No, because controls, let me rephrase, materiality is not relevant when you're doing controls testing. It doesn't come into play. You can't use it as a justification for the control not working. It only is a valid consideration when you're doing a substantive test, okay? So please be mindful of that. Materiality is not relevant when you're doing controls testing. It's only relevant when you do substantive testing. Now, sampling and audit evidence. So considerations you need to have. We have discussed this before, but under ASA 500, the auditor must obtain sufficient, which is a measure of quantity, and appropriate, which is a measure of quality when it comes to evidence. So essentially, we need to collect enough good quality or reliable audit evidence to support our conclusion. So please be mindful of that. Now, in terms of sampling, haphazard sampling method, which if you remember from last week is the human equivalent of random, right? Haphazard is actually the most common method that we use, particularly if we're testing by hand. Why? It's the most convenient. So you're in the warehouse and you say, okay, I'll pick this, 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 and this. It's just convenient. You're there, you just pick it. You try to be random, but as we know, you're not random, okay? But haphazard is often the most common method. Random, on the other hand, is the best one to use if you're testing a large sample and you're using some form of technology to do so. Okay, so they're essentially the key ones I just wanted to distinguish because people often get mixed up. All right, but as I said, you are not going to be asked to calculate sample size. I might ask you when you would take a bigger or a smaller sample or which sampling technique you should use, but I'm not going to ask you to give me a number. Now, what factors affect the reliability of audit evidence? So what factors determine whether evidence is reliable? Now, we've gone through this list a few weeks ago, so I'm not going to go through this with you. I'm just going to give you a couple of options. And I want you to tell me, of these options that I give you, which one is more reliable audit evidence. So you can read this yourself, but here we go. So if you have a choice of collecting evidence from a third party versus the client, which one will result in more reliable audit evidence? So third party or client? All right, good. If you have a choice, or if you have a choice of two options, and that is to have the evidence in hard copy, so on paper, versus verbal evidence, which one's more reliable? Awesome. If you have a choice between the original copy of a document and a photocopy, which one's more reliable? Excellent. Remember that. Remember, it's not that complicated. It's quite logical most of the time. These are the key factors that we refer to. And by the way, you may see just answered questions on the independence of the provider and also objectivity. The more judgment goes into the preparation of the evidence, the less reliable it is. Okay? And again, we've gone through all of these. So go back through your notes because I do want you to know this, but again, it is quite logical. Okay? So the source of the information, the nature of the information, the objectivity of the information, and so on and so forth. Now let's just test this out by doing this question. I think it's the last one, yeah. Okay, here's the question. Which of the following is the most reliable procedure to obtain audit evidence? So we've got A, confirmations, B, inquiry of management, C, inspection of documents, or D, recalculation. So we'll take a vote. Who thinks that the most reliable one is A, confirmations? Straight up. Okay. And everyone has to vote, by the way, so I'm keeping track of this. So one more time. Who thinks it's A? Okay. Who thinks inquiry of management? Excellent. So straight away, that should be out because talking to someone is never going to be enough. All right. C, inspection of documents. Okay. And D, recalculation. Interesting. Okay. Now, here's the thing. These are good, but not as good as this. Okay. And the reason is this. And I urge you all to go back to your notes on this one. You know what we call confirmations? We call them external confirmations. Why? Because we are confirming the information to a third party or with a third party. Okay, they are called external confirmations. Now, even though inspection and recalculations, they're good, they are solid evidence, it's not as good as the confirmations. Why? Because remember, with confirmations, if we're contacting like the bank or we're contacting customers or we're contacting the suppliers and we're saying, is this information true? Here's the thing that you need to be very mindful of. The reason why before you said that it's most effective to get evidence from a third party rather than the client is because as soon as information goes through the client to get to you, it loses reliability. Why? Risk of manipulation. With confirmations, the client is not involved at all. So it literally, we draft it up as the auditor, we draft up the document, we send it to the third party, and the third party responds directly back to us. The client is not involved at all. Guys, stop hacking up because there's something else I really need to tell you. So out of these four confirmations, they are the most effective or the most reliable evidence, but we only really use confirmations for certain accounts. It's often just balance sheet accounts, but we often use them for either cash, accounts receivable, accounts payable sometimes, and loans. So with cash and loans, we talk to the bank, right? We send a confirmation to the bank and we say, is it true this is how much money they have in their bank account, or is this true this is the value of their loan? Now, those ones, that's fine. That gives us confirmation over, that it exists, it's the right value, it's complete, all that stuff. Here's the one I want to talk to you about, is this. Accounts receivable. Now, every customer that owes the business money is called a debtor. Okay? A debtor is anyone that owes the business money. So what we call these types of confirmations are, we call them debtor confirmations. Now, we draft it up and we send it to a customer and we say, is it true that you owe the business this much money? Now, here's the most important part of this. By getting a response from the customer, what assertion does that gain comfort over? What do you think is the main assertion we gain comfort over by them responding? What do you think?
Existence.
Why do you think existence?
Because they can, the valuation, they're not going to report if it's there.
Absolutely. Guys, if you didn't know this, write this down. Specifically when it comes to debtor confirmations, if they come back, it actually only gives, well, not only, the main support it gives you for, which assertion it gives you the most support for, is existence. Because here's the thing, if they respond to you, they exist. The customer is real. So that gives you comfort that it exists. But here's the thing, a lot of people think, oh, valuation allocation, it means the number's right. No, it doesn't. Because customers, and we've talked about this before, they can lie. If we send a customer a debtor confirmation and we say, is it true that you owe the business $10,000? They check their records and they only owe $1,000. They're going to come back and say, no, stupid auditor, I only owe $1,000. But flip it around. If we say, is it true that you owe the business $1,000, but they actually check their records and they owe $50,000, they're going to be like, cheers, okay? Because why? One fundamental thing, they can lie. They can lie. Because remember this, if you're sending it to the customer, they have something to gain from lying. As a result, it actually doesn't give you full support for valuation allocation. The best one it does is existence. Now, in saying that, that is specific to this one. When it comes to the bank, for cash and for loans, the bank has nothing to gain from lying to you. So those ones will give you comfort over valuation as well. But with customers, because it specifically relates to them, they can lie to benefit themselves. And in saying that, remember the overriding thing, we don't get many of the confirmations back anyway. Okay? So it is, even though it's a great procedure, it's often one that we don't reap too much reward over. Now, the final reminder here, guys, there's no single right procedure. We've been saying this a lot. There are many ways that you can test the same assertion. So, where are we at? Now, up until now, we've actually gone through the majority of the audit process. We now know that we start off by gaining an understanding of the client, its business, how it operates, and the industry in which it is in. It is based on that understanding that we perform risk assessment. We are able to assess inherent risk and control risk, and based on that, we set detection risk. Now, once we know the detection risk, use that table that we talked about, we are able to design our audit strategy. What's the plan? What's the approach we're going to take to the audit? Is it substantive? Is it controls-based? Is it a combination? Once we know that, we go ahead and we conduct our testing, our controls testing, our substantive testing, and we collect our evidence. Once we do that, we go from there to here, we evaluate. Now, you know how to evaluate your results. We discussed it last week. The process between our controls testing and substantive testing in terms of valuation is pretty similar, but remember the key terms that are different. Now, what we haven't focused on yet, in detail anyway, is what comes after that. Once you evaluate your results of the testing, we actually communicate with the client. We communicate with management. We say, look, these are our results and this is what you need to adjust. And the negotiation process begins. Once that happens, we finalize the audit. There are a few things we do at the very end, which I'll take you through next week. And based off everything that comes together, I guess, at the end of the day, we determine our audit report and we determine our audit opinion and we prepare the final audit report. Ladies and gentlemen, we have done everything except the final stage of the audit. And that will be the topic next week. Next week is the final new topic, and the following week is our final revision class, okay? You're almost there. So guys, home stretch. You need to make sure you're comfortable now. Remember, next week is your catch-up tutorial as well. If you are having issues, please let me know, but you are almost there, okay? Well done. I will see you next week.